Hello guys and welcome back to the channel. This video is going to be one of the most important videos if you want to be a successful options buyer. The concept of strike selection is a highly discussed topic in options, but only a very few people actually know how to select a particular strike at a particular time of a particular option contract. And moreover, you need to have a proper reasoning as to why you have selected that particular strike or strikes. In this video, we are going to do exactly that. I will help you encounter most of your fears when it comes to options trading. I will discuss the strike selection process from an option buyer's perspective. I won't be discussing the strike selection for an option seller because it is yet another vast topic of discussion. Maybe I will make another detailed video for that if this video gets at least 1500 likes. And make sure to watch this video till the end without skipping because there won't be any loose talks and each and every point is an important piece of information that may transform the way you trade options the next time. So make sure you like and share this video for the effort and time put into creating quality content. And if you are new to this channel, make sure to subscribe and enable the bell notification, and I guarantee that you won't regret it. So without wasting any time, let's get things rolling. I have already made a video on option chain and how to analyze an option chain, where I have talked about all the basic stuff related to options trading, from what are call and put options, what is spot price, strike price, what is moneyness of options, that is what are ATMs, ITMs and OTM option strikes, and I have discussed in detail on how to interpret open interest data. So in order to understand the concepts that I am going to discuss, you need to have the basic knowledge on call and put options, spot and strike prices, and how the moneyness of call and put options are different from one another. So if you are new to this, I recommend you watch that video first and then proceed to watch this video. So with that being said, we will start our discussion of strike price selection for option buyers. I know most of you retail traders are option buyers, and the reasons for this is quite simple. First of all, it takes less capital to buy options rather than to sell them. You can buy a large number of lots for a comparatively lesser amount of money. Moreover, you get more value for your money if the trade goes in your favor. The returns that an option buyer can make is mind-blowing. Also, you don't need to be bothered about any peak margin penalty, or you don't have to deal with the complex looking Greeks like theta, gamma, delta, etc. And all you need to have is a directional bias. Then select the option you want to buy, be it a call option if you have a bullish view or a put option if you have a bearish view. Then select the strike price you want to trade. And if the price moves in the direction that you anticipated it to move, then you stand to make a lot of money. Now these are all the good stuff when buying options. But if it was too easy, why do most option buyers fail terribly in the market? Why do 80% of them lose all their capital within a few days or weeks? Let me tell you why. The first and foremost reason is the lack of proper knowledge about the world of options. When you see someone making a killing out of the market, making lakhs and crores within days or weeks, you instantly get the fear of missing out, and you step into the market with hard-earned money only to see it burn. The second reason is the lack of awareness of who your friend and enemy is. See, when you are an option buyer, momentum is your friend and premium decay due to theta is your enemy. The third reason is critical: strike price selection. Most low capital option buyers buy deep out of the money options just because it is cheap. And for sure, you are not going to make any money out of these OTM strikes. You need to realize that you trade options to make money rather than not to lose money. The fourth reason is associated with an inherent property of options. Options are decaying assets, meaning that the time value of option premium reduces with time, and it is more evident when we get closer to the expiry. Now, one of the biggest reasons why most option buyers go broke is due to the lack of proper stop losses. Most of them try to average their losses instead of cutting their losses. Your stop loss will depend on the strike price that you have selected. So for an ATM and OTM options, the stop losses will be different. And the golden point that most traders, be it option buyers or option writers, miss out is that in options, you need to buy into volatility and sell into stability. See, when markets and stocks become volatile, options become more valuable as the premiums rises. In short, volatility means that the stock or the index can swing wildly in either direction. As an option buyer, even though your risk is limited to the premium paid, but on the upside, your returns can be boundless. So when volatility rises, it is the time to buy options and not to sell options. Now, I don't want to confuse you with a lot of volatility stuff, but keep in mind that when volatility is rising, you should be buying options, and when volatility is reducing, you should be selling options. It is when you play against these rules that you lose money in options. Now, I will make a detailed video on the volatility topic if you want. Please do mention in the comment section. Now, let's look into the strike selection process if you are into option buying. I'm hoping that you have a decent enough strategy, be it any reversal strategy or breakout strategy or volatility contraction and expansion strategy or mean reversion strategy or any other strategy where you expect the prices to move strongly or with momentum in your desired direction. Now you can ask me, why do you want prices to move with strong momentum? This is where we will look into the significance of delta, which is a very important option Greek for buyers. I will try to explain this concept as simply as I possibly can. Actually, delta is the change in the option's price or premium due to change in the underlying futures price or spot price. Delta is not an absolute measure, but instead it is a percentage measure. Think of it like the speed of a car. Similar to how fast or slow a car moves when its speed increases or decreases, the option premium increases or decreases with respect to changes in delta value. Similar to the speedometer of a car, where the speed is capped between 0 km per hour to some 150 or 220 km per hour, the delta values are also bound between 0 and 1 in case of call options and 0 and -1 in case of put options. Now you may ask, why this difference? The explanation is quite simple. This is because a rise in the price of a stock or its futures is positive for call options, because when the stock or future price rises, call option premiums increases in value, while it is negative for put options because a rise in stock or futures price is associated with a decline in put option premiums. In fact, the negative sign is to show this difference and nothing else. So in short, call options have a positive delta. For example, a call option with a delta of 0.3 indicates that for every 1 point gain or loss in the underlying, the call option premium gains or losses 0.3 points. On the opposite, put options have a negative delta. So a put option with a delta of -0.4 indicates that for every 1 point gain or loss in the underlying, the put option premium gains or losses 0.4 points. Now, one thing that I want to point out is that option premium is not just related to delta only, but instead it is obtained as a result of taking many other factors into consideration, such as volatility, time to expiry, interest rates, dividends, etc. But for simplicity, we are going to continue using this assumption, and the difference between the actual value is quite negligible if your position sizing is not too large. Now, take a look at this graph. It shows the relationship between different option strikes and the delta for call and put options. From this graph, it is clear that the OTM options have a delta value between 0 and 0.5, ATM option has a delta of 0.5, and ITM options has a delta between 0.5 and 1 in case of call options. And for put options, OTM strikes have a delta between 0 and -0.5. ATM option has a delta of -0.5, and in the money option has a delta between -0.5 and -1. So what we can infer from this information is that as the option strike changes from OTM to ATM to ITM, the delta changes, therefore the premium changes, and the option start to mimic the underlying, meaning that for every rupee change in the underlying value, the option premium will also change a rupee. Let's take a few examples to understand these concepts better. Let's say the Nifty spot price is 18,010, and so the at the money strike is 18,000. Now, if we consider the 18,000 at the money call option, which is priced at 100 rupees and the delta value is close to 0.5. What this means is that for every 1 rupee change in Nifty spot price, the 18,000 call option premium will increase by 0.5. So if the spot price changes to 18,020, that is spot price increased by 10 points, then the call option premium will increase by 5 points to 105 rupees. And if Nifty falls to 18,000, that is spot price decreased by 10 points, then the 18,000 call option premium will drop 5 points to 95 rupees. Now what will happen to the delta value of 18,000 call option when Nifty spot price rises or falls by 100 points? That is, it becomes 18,100 or 17,900. Do you think the delta will still remain at 0.5? No, right? When the Nifty spot increases 100 points to 18,100, the 18,000 call option strike, which was ATM before, now becomes an in-the-money option. Since we know that the delta range of ITM options is between 0.5 and 1, and so in this scenario, the delta will vary between 0.6 and 0.7, which will in turn mean that the strike price premiums will increase faster than before. Now on the opposite, if the Nifty spot price were to fall 100 points to 17,900, then 18,000 call option strike, which was at the money before, will now become an out of the money strike. So naturally, the delta value will reduce from 0.5 and it will now range between 0.3 to 0.4, which in turn implies that the option premium will now move slower than before. Let's look at a similar example for put options to have a solid understanding of the concepts. Let's assume that the Nifty spot price is 18,010 and so the at the money strike is 18,000. Now if you consider the 18,000 at the money put option, which is priced at 110 rupees and the delta value is close to minus 0.5. This means for every 1 rupee change in the Nifty spot price, the 18,000 put option premium will change by minus 0.5, and for every 1 rupee drop in the spot price, the ATM put option premium will rise by 0.5 rupees. So if the spot price changes to 18,020, that is, the spot price increase by 10 points, then the put option premium will decrease 5 points to 105, and if Nifty moves to 18,000, that is, the spot price decrease by 10 points, then the 18,000 put option premium will rise 5 points to 115 rupees. Now what will happen to the delta value of 18,000 put option when the Nifty spot price rises or falls by 100 points? That is, it becomes 18,100 or 17,900. Do you think the delta will remain at minus 0.5? No, the delta will actually change. When the Nifty spot price increases 100 points to 18,100, the 18,000 put option strike, which was at the money before, will now become an out of the money option. Since the delta range of out of the money options is between 0 and minus 0.5, so in this scenario, the delta will vary between minus 0.3 or minus 0.4, which will in turn mean that the speed of the strike price premium changes will be slower than before. Now on the contrary, if the spot price were to fall 100 points to 17,900, then the 18,000 put option strike, which was at the money before, will now become an in the money strike. So naturally, the delta value will increase from minus 0.5 and it will range between minus 0.6 to minus 0.7, which in turn implies that the option premiums will now move faster than before. So let's summarize what we have learned so far. Number one, when the spot price of the asset changes, the moneyness of an option changes and therefore the delta also changes. Number two, since the delta changes with changes in spot prices, delta is actually a variable and not really a fixed entity. Therefore, if an option has a delta of 0.5, this value is likely to change with change in the value of the underlying. And third point, the call options delta varies from 0 to 1, while put options delta varies from minus 1 to 0. I'm hoping that you now have a fair understanding of what delta is and how it changes for different strikes based on the type of option contract that we are looking at. So we are now ready to understand the concept of strike selection for buyers of options. This is the concept of delta acceleration. Okay, have you heard about hero or zero trades, where someone usually buys an out of the money or sometimes even a deep out of the money option, and the next day, based on where the market opens and moves, the trader stands to make a killing, generating mind blowing returns, or on the opposite, he might lose all the premium he paid. Do you know why these people take these risky trades, and particularly why they select out of the money strikes? Now, there can be different reasons. Number one, out of the money and deep out of the money options are much cheaper, so you only need to deploy lesser capital. Number two, since the premium paid is lower, the amount being risked is considerably lower, even though you stand to lose the entire premium amount. But the potential return that is available for the taking is limitless. But the most important reason, and maybe one of the reasons that most traders don't realize or maybe they don't care about, is due to delta acceleration. Let me explain this with the help of another graph. This right here is the delta acceleration graph, whose y-axis is the delta value from 0 to 1 for a call option, or maybe 0 to -1 for a put option. The x-axis represents moneyness of options for a change in spot price of the underlying. Now the concept is same for both types of option contracts, so we will discuss it based on call options. Now there are 4 delta stages in the graph, from pre-development, takeoff, acceleration and stabilization. Now let us look into each one of them. Trust me, this is easier than you expect, so stay with me on this. Before we move ahead with the discussion, let me give you an example. Think of this curve as the different stages of a flight. Let me explain. At first, the airplane engine is turned on and it is on one side of the runway preparing for takeoff. But as of now, there is no visible movement. This is similar to the pre-development phase of Delta. Now, the plane starts to move, increasing its speed, or we can say the plane is gradually accelerating against a headwind. Now, this is similar to the second phase of the Delta curve, where the Delta tends to take off, or in simple terms, the Delta values starts to accelerate gradually. Now the aircraft acceleration increases so much so that the headwind lifts the plane up, and this is where the aeroplane accelerates the most in order to counter the air resistance. This analogy can be used to represent the third stage of the curve, where the delta values accelerate the maximum and move so quickly. And finally, after reaching the desired height, the plane will stabilize and cruise at a particular speed. Analogous to this, the final stage of the delta acceleration curve is stabilization, where the delta gets capped at a high constant value, which is 1 for call options and -1 for put options. Now you can think of this the other way around also, which is analogous to when an airplane prepares to perform a landing. But in that case, instead of the flight accelerating, it is actually decelerating. So the delta in the opposite situation will also decelerate and gets capped down to a lower value, which is 0 for both call and put options. Now pardon me for this terrible physics lesson, but I hope you understand my point, right? Now let's look at the 4 stages once again and come to a conclusion as to which strikes are the best to buy if you are an option buyer. But as a side note, delta of an option changes with other factors other than the spot price itself. But for the sake of simplicity of calculations, we will consider that the delta of a particular strike remains the same even if the spot price changes. So the first stage is pre-development. Now, this is the stage when the option is out of the money or deep out of the money. So the delta value here is 0 or close to 0. Now the delta will remain close to 0 even when the option moves from deep out of the money to out of the money. For example, when the Nifty spot price is 18,000, then 18,500 call option is deep out of the money, which is likely to have a delta of anywhere near 0.05. Now, even if the spot price moves from 18,000 to, let us say, 18,100, the delta of 18,500 call option will not move much, as 18,500 call option is still an out of the money option. The delta will still be a small non-zero number like 0.09 or something. So if the premium for 18,500 call option when the spot value is at 18,000 is rupees 10, then when Nifty moves 100 points to 18,100, then the premium is likely to move by 100 multiplied by 0.05, which is equal to 5 points. Hence the new premium will just be rupees 15. Now this may look like a very small change on an absolute scale, but when you think of it in terms of percentages, then the option has increased 50%. So what is the conclusion that we derive from this observation? Even though deep out of the money options tend to have an impressive percentage returns, but for such a thing to happen, the spot price has to move by a large value. So as an options buyer, would you buy deep out of the money options? Personally, I would ask you to avoid buying deep out of the money options because first of all, the deltas are really small or the speed of the premium change is negligible. And secondly, the underlying has to move massively in order for the options to work in your favor. However, for the exact same reasons, selling deep out of the money options makes sense. Now the second and third phases are takeoff and acceleration. This is where the maximum potential for making money lies and therefore greater the risk. Now let me explain. Now takeoff is a stage when an option transitions from out of the money to at the money. Consider that Nifty spot price is at 18,000 and the call option strike under consideration is 18,200 call option, which is a slight out of the money option whose delta is close to 0.25 and the premium is rupees 25. So when the spot price moves 100 points from 18,000 to 18,100, what do you think will happen to 18,200 call options premium? Since the delta is 0.25 and the change in underlying is 100 points, the change in the premium will be equal to 100 multiplied by 0.25, which is equal to 25 rupees. And therefore, the new premium will turn out to be 25 plus 25, which equals to 50 rupees. And that, my friend, is a 100% return. Now, isn't it clear that for the same 100-point move of the underlying, the slightly OTM options behaves very differently from deep out of the money options? So what have you learned from these observations? The slightly out of the money option, which usually has delta values ranging between 0.2 or 0.3, is more sensitive to price changes in the underlying. Now, as we have seen, for 100 points change in the underlying, the percentage change in the slightly out of the money options is quite spectacular. Now, this is exactly how options traders double or triple their money by buying slightly out of the money options when they expect big price moves in the underlying. But does this mean that we have to stick with buying slight out of the money options as an option buyer? Well, we are not quite there yet to answer the question. Let us take this a step forward and see how an at the money option, that is 18,000 call option in this case, which has a delta of around 0.5, would react to the same 100-point move in the underlying price, which moves from 18,000 to 18,100. Let's say the premium of 18,000 call option is 70 rupees. Then for a 100 rupees change in the spot price of the underlying, the option premium is expected to move 100 multiplied by 0.5, which is equal to 50 rupees. So the new premium will become 70 plus 50, which is equal to 120 rupees, which is a decent return of 71.4%. Now, are we ready to make a conclusion? Not yet. We have one more stage to consider. And the final stage is stabilization. This is when an option transitions from at the money to ITM and deep ITMs, and the delta starts to cap and stabilize at the maximum value of 1 for call options and -1 for put options. It is evident from the graph that the delta of call options will start to flatten out when it reaches the maximum value of 1. This means the option can be in the money or deep in the money, but the delta gets fixed to 1 and the delta would not change any further. Now let us understand how this works. Consider Nifty spot price to be 18,000 and consider two call option strikes, namely 17,900 and 17,500. 17,900 is a slightly in the money option having a delta of 0.65 and a premium of 120 rupees, while 17,500 call option has a delta of 0.95 or assume it to be 1 and it has a premium of 340 rupees. Now if the underlying changes by 100 points, that is Nifty moves to 18,100, then how do you think the two options will behave? To figure that out, the change in premium for 17,900 call option will be equal to 100 multiplied by 0.65, which is equal to 65 rupees. So the new premium will be equal to rupees 120 plus 65, which is equal to 185, which is a 54.2% rise. While in case of 17,500 call option, the premium change will be equal to 100 multiplied by 0.95, which is equal to 95 rupees. So the new premium will be equal to 340 plus 95, which is equal to 435 rupees, which is just a 28% rise in premiums. Now, when we observe closely, we can infer that in terms of absolute change in the number of points, the deep ITM options wins over the slightly ITM option. However, when we consider it in terms of the percentage change, it is the other way around. Clearly, the slightly ITM options are more sensitive to changes in the underlying, but they are certainly expensive than ATM and slightly OTM options. Now, what are the conclusions from all these observations? So one of the key takeaways from this graph is that delta values are capped after a particular limit. This means that irrespective of how much the spot price falls, and even if the call option goes from out of the money to deep out of the money, the option's delta will cap and will remain at zero. Similarly, even when the delta moves beyond ITM to say deep ITM, the delta value does not change, or it stabilizes and stays at its maximum value of 1. You can notice similar characteristics for put options delta also. Therefore, as an option buyer, you should avoid trading on deep in the money and deep out of the money option. The reasons being, deep out of the money option is not sensitive enough to the underlying price moves, so the absolute premium change is negligible. Now, in terms of deep in the money options, it is certainly expensive and most of the time it is illiquid. But since it has a very high delta value, meaning that they are more sensitive to changes in the underlying, we could buy deep ITM options instead of futures contracts for the same underlying for a much lower price. For example, one lot of Nifty futures cost roughly around 1.5 lakhs, while one lot of deep in the money options cost anywhere just from 40,000 and above. So it's relatively cheap. But the downside is that options are a decaying instrument unlike futures, and secondly, most of the time deep ITM options are illiquid, so there might be large slippages. The second point is when you expect big price moves in the underlying. Then I will recommend you to buy slightly OTM options because you can expect to win big given the fact that the delta acceleration really come into action during the takeoff and acceleration phase. During big price moves in underlying, the slightly out of the money options tends to move quickly between the different stages of ATM to slightly ITM, giving eye-popping returns. Now, if you don't expect very big price moves or you just want to scalp the market, then at the money options are the best. It is more sensitive to changes in the spot value when compared to out of the money options, and it is much cheaper than slightly in the money options. And since at the money options delta is high, the underlying need not really move by a very large value. And even if the underlying moves by a very small value, the option premium will change. So in short, if I were buying options based on some momentum strategy, I will definitely choose a strike having a delta from anywhere between 0.35 and 0.55. That is, I will buy either a slight OTM or a slight ITM or an ATM option strike, depending on how strong my conviction is regarding the price movement in the underlying. Now, this is a very simple hack that you can use if you are an option buyer. And as a closing note, options behave differently when it comes to expiries. As you may know, that during expiry, all the out of the money options will go to zero, and so will their deltas. This is perfectly explained using this particular graph. The horizontal axis shows the days until expiration, and the vertical axis shows the delta values. So as you can see, both call and puts are approximately at plus or minus 0.25 delta with 21 days to expiration. As time erodes, there is less and less chance of both the OTMs and deep OTMs expiring in the money. So the corresponding delta for each option approaches zero as the expiration date closes in. So try to stay away from OTM strikes when you are very close to the expiry. I hope you guys now have a clarity and proper reasoning as to how to select a particular strike when buying options. Now, there are a lot of other factors playing in the market that affects premium, like implied volatility, time decay, etc. But this is a simple and less complicated method for strike selection. But make sure you follow up what you have learned and practice it regularly and see if you have improved your position in the market. Continue following it for a while and you will be able to select strike prices like a machine. Now that is all what I wanted to share in this video. If you want a detailed video on the strike selection for option sellers, please do mention it in the comment section. And if you have learned something new today, make sure to like and share this video. Do subscribe to the channel and enable the bell notification so that you won't miss out on any upcoming videos. I will see you guys with another video. Till then, bye.